Hello guys, hope you are doing great. In this video, we will cover the last chapter in the accounting syllabus, chapter 22, and this is so near to what we studied in the business studies in chapter 25. This chapter is also talking about the analysis of the financial statements. And why we are analyzing the financial statements? Mainly we are analyzing the financial statements in order to evaluate the performance and the progress of the business and to compare this performance with the previous year's performance and compare it also to your competitors' performance. So in order to carry out this comparison, we are going to use the ratios, and main two groups of ratios that we are going to use are the profitability and the liquidity ratios. The same as we studied in the business studies, the profitability ratios, we have three types of ratios. The returns on capital employed, the gross profit margin, and the net profit margin. The return on capital employed is measuring your net profit in terms of the capital employed. What is the capital employed? It's the capital you invested in the business and the long-term loans that you borrowed from the bank in order to also invest it in the business. Adding these two figures, you will get the capital employed. And this ratio is going to measure how much profit net profit you are generating from this capital you are investing in the business. So in order to calculate this return on capital employed, we need to add the capital invested by the owner plus the long-term loans, and we need to have the net profit. So of course you know that the net profit figure, you will find it in the first and the second section of the income statement, the profit and loss section, and the capital and the long-term loans, you will find it in the balance sheet. In your textbook, you will find here in example 22.2 is given to you here the balance sheet. You have the total capital, which is the opening balance of the capital plus the profit of the year minus the drawings made by the owner. So this is the net capital for the year. Adding to it the long-term loan, which is $20,000. So the total capital employed will be 123 plus the 20, 143. And from the income statement, you will find here the profit of the year, or the net profit, is $15,000. So this is how we are going to calculate the return on capital employed. The $15,000 divided by the 143 multiplied by the 100. This means that for each $100 that you invested in the business, you are gaining a net profit for $10.4. The second type of profitability ratios is the gross profit margin, or the gross profit as a percentage of sales. Both two figures, you will find it in the first section of the income statement, the gross profit and the sales. And this is measuring how much gross profit you are generating out of each $100 of sales. So let's go back to the income statement. Here is the gross profit, the 8,500, and here is the sales, the $10,000. the gross profit is the $24,000, and here the sales is the total of the cash sales and the credit sales, which is the 120,000. Of course, you know the cash sales are the money you gained in cash out of selling your product, and the credit sales are the sales that you made and you will collect it from your clients. You will collect the cash later. Okay, so the total of these are the total sales or the total revenue, the 120. Okay, so the gross profit margin or the gross profit as a percentage of sales is the 24,000 divided by the 120,000 multiplied by the 100, this ratio. So 20% gross profit margin means that for each $100 you are generating as a sales, you are making $20 as a gross profit. If you find that this ratio is too low and the business want to improve this ratio, so we have to either increase the selling price, so accordingly we will increase the total value of the sales, or you have to decrease one of the components of the gross profit, so you have to decrease the cost of sales, and decreasing the cost of sales may be done by obtaining cheaper supplies, or you can, in order to improve your sales, means that you want to sell more, not to increase the selling price, you want to sell more, so you may increase your advertising, doing more advertising campaigns, so you will sell more. So without increasing the selling price, increasing the quantity of sold items will increase your total sales, accordingly increasing your gross profit. The third and last ratio is the net profit as the percentage of sales. Also, you will find the sales in the first section of the income statement, and the net profit in the second section, or you will find it as the profit for the year. Here is how you will calculate it: the net profit divided by the sales multiplied by the 100, and is 12.5. This means that out of each $100 you are collecting as a sales, you are making a net profit of $12.5. This was the three profitability ratios: return on capital employed, gross profit in terms of sales, and net profit in terms of sales. The three profitability ratios, we are using them in order to check how profitable was the business in the ended financial year, and use this ratio in order to compare the performance of the business with the previous years and compare it with the other businesses. Then we are moving to the liquidity ratios. First type of liquidity ratio is the current ratio, and liquidity ratios are measuring the ability of the business to pay its short-term debts and its ability to convert its assets into cash in order to pay its current liabilities. So in order to calculate this first ratio, the current ratio, we are going to divide the current assets by the current liabilities. And of course, you know that both figures, the current assets and the current liabilities, you will find it in the balance sheet. So this ratio is measuring the business ability in order to use its current assets. The current assets are the cash, the inventories, and the trade receivables. To use these current assets to pay its current liabilities, or the bank overdrafts, or the trade payables. So if this ratio lies between the 1.5 to 1 or 2 to 1 means that the current assets are 2 times the current liabilities, this will be satisfactory for the business. More than 2 to 1 means that the current assets are more than the double of the current liabilities. This is not a good sign for the business. Also, you are able to cover your current liabilities, but this means that you are maybe you are saving your cash and you are not using it in another profitable purpose. You may use this cash in order to invest it in the business, in order to buy a new machine which will generate more profits to the business, will be more productive and produce more, so you will sell more and generate more profits. So having too much cash is not a good sign for the business. And having too low current assets in terms of the current liabilities, this may make you face problems when you are going to pay your liabilities, and delaying paying your liabilities will make your suppliers lose trusting you, so they may stop supplying you with your raw materials, and you will lose the advantage of taking cash discounts from your suppliers in case you are paying on time. So in case you are facing a problem that your current assets are not sufficient to pay your liabilities, so you have to find another source of finance, another source to generate cash in order to pay your liabilities. This source may be internal or external. Internal source of finance may be injection for the capital by the owner, or maybe by obtaining a long-term loan from the bank, maybe by selling some of your fixed assets that you are not using. So this is how you are going to get cash in order to pay your short-term liabilities.